Hello everyone, welcome to my channel. Well, we have entered the gates of hell today on Friday because the Sahm, S-A-H-M rule has been invoked by the unemployment rate going up too much, too fast, too quickly. The way this works is when you're going towards a recession, the unemployment rate starts to take off a little bit, but then it starts to cascade on itself, and all of a sudden you're at 5, 6, 7, 8% unemployment before you know it. The Fed's got to be worried that they are behind the curve now, and the risk of them lowering rates by more than a quarter of a point has increased significantly. There's now like an 80% chance they're going to reduce interest rates by 0.5 in the middle of September. As can be seen from the chart, everything got shellacked. The Dow and the S&P 500 went down about 2.1%. The NASDAQ went down about 3.4%. And the Russell 2000 and the IWM is the ETF for the Russell 2000. That was expected to hold up. That was supposed to be our savior, that people would rotate from the big stocks into small stocks. That fared the worst of all. The Russell 2000, the IWM, went down 6.8%. I played around with the small stocks when Tom Lee first came out with this idea that the small stocks would rocket up because he seemed so compelling. A while ago, I saw this wasn't going to go, and especially now, it's even more evident. It's very rare for small stocks to do better than large stocks. That tends to happen more at the beginning of an economic boom, at the beginning of a bull market, not towards the end of a bull market, which is where we were. And now, the fear is that we're at the beginning of a bear market. We're well on our way to a 10% correction. The volatility indexes are not encouraging. And looking at the chart, you can see that the VIX, which is a measure of the volatility of stocks in the stock market, it has gone up from about 12 to over 23. It's gone up over 91% in the last month. Unbelievable. When it goes over 15, you usually have a pullback. When it goes over 20, that's when I start thinking about shorting to some extent. Unemployment is up 0.8% in the last year. The chart you are looking at is the unemployment rate as of Friday, which came out at 4.3% when it was only 4.1% previously, and only 4.1% was forecast. This was a big surprise. It triggered the Sahm rule, and the stocks went down. At the next Fed meeting on September 18th, there is now a 31% chance that they will cut rates by a quarter of a point, but there's a 69% chance that they will cut interest rates a full half a point. And of course, the headlines are horrible. Tech stocks see the steepest 3-week slump in 2 years, led by a plunge in Amazon and Intel. I think Intel lost like 27% in one day today. That is the largest amount taken off their market capitalization in their history, I believe. The NASDAQ composite fell 3.4% this week, bringing its 3-week drop to 8.8%, marking the worst stretch of that length since 2022. The sell-off underscores investor concerns around forecasts for the back half of the year. Amazon, Intel, Microsoft, and Nvidia have seen some of the steepest declines. I'm showing you this chart to give you some idea of the carnage in the stock market in the last month for large technology. Intel has lost 30% in the last month. Amazon has lost about 14%. Microsoft has lost over 10%. And Apple is the lone survivor of actually making some money in the last month. It made 1.43%. I guess there's a reason Warren Buffett makes Apple 40% of his stock portfolio, and Nvidia lost about 13%. Market sentiment as measured by the CNN Fear and Greed Index, shows that fear has increased. We are now well into the fear category at 27. We're very close to being at extreme fear. A week ago, it was neutral at 45. And the previous close, the day before yesterday, it was in fear, but it was at 39 and was much closer to being neutral. So we're swinging into fear. I think the realization that we're probably going into recession is settling in. And I don't think it's something that gets resolved quickly. I think it's going to be a couple months of coming out of this. What's also troubling is the 10-year bond interest rate has plummeted. It is now at about 3.8%, 3.799% to be exact, at the end of trading on August 2nd, Friday. When the yield curve uninverts, which is what it's doing now, that's usually when you have very increased odds of a recession coming. So a recession looks like it's in the books, and it's just how you want to play a down market. Do you want to wait and just let it settle down and save your money and probably try to invest when it starts to take off to the upside somewhat? That's usually been my strategy, and that's usually what's successful. I might day trade a little bit on the short side, but I'm not going to go into it in a big way just because this market is so difficult and choppy. I hesitate to do that. The safest thing is to save your money and wait for this catastrophe to stop. And then when it spikes up, I always I got to have the spike to begin to get back into it. I will never catch the exact bottom, but I never will be flushed down either. And that's the way I roll. Thank you very much for listening.